All right, back again with the man, the myth, the legend. That man, Jay Cota, was previously on a call with a new client, with a new realtor client. Sounded soft as hell. Just want everybody to know that. Hi.
I didn't want to make you feel bad that there's other realtors in my life.
Hey man, there can only be one. Whoa. But today we're trying to cover, we're going to be formatted like we told we were going to be. And today we're going to cover a couple things, specifically transitioning from homes, right? Like everybody always is worried about buying the first home, and I get it, whatever. But arguably, an even more challenging scenario is buying your second home because there's certain things that you have to take into account. So, first question for the lending god: what in your side of the house for when should someone consider renting a home versus selling it for their second home? Because we get that question a lot.
Sure. So, like renting their current primary out and holding on to it versus buying a new primary. Anytime you can hold on to an asset like real estate, especially in a market like San Diego, where rents aren't expected to really be going down anytime soon, as long as you can cover your downside, I think it makes sense. Now whether you have a background in being able to manage a property or you look into a property management company, which might make it a little bit easier on you, I think the asset itself is worth holding on to. I think where a lot of people run into that is a bit of fear, in making that decision because it is going to be extra work. It's another job if you're going to self manage that property. If you're looking at having somebody else manage it for you, then all you really need to do is just make sure you've got a quality, property management team behind you to make sure things are running efficiently. Understand, long term versus short term benefits on rent. But anytime you can hold on to an asset in a market like San Diego where inventory is limited, you're only going to see growth, substantially over the years. I mean, the longer you can hold on to real estate, the better.
Yeah, that's always advice too. Like everybody wants to, they're like they see how much property management companies charge, like 10% or whatever, and they're like, I want to save that money. I always tell them, do not just instead of having to manage, maintenance and the tax roll for your house, all that stuff,
Well,
and
time involved in it. If you've got another
time.
job, time is money, right? Also, I mean, if you're running your investment property like a business, I mean, that's an expense to your business. So that's going to
Exactly.
be able to be deducted from your bottom line anyways when you're
Exactly.
talking about, any other expenses for operating an investment property and rental. So, I mean, it does help with the bottom line as far as, again, not a CPA, but, it is a tax deductible expense on a rental property.
Oh yeah,
Right.
and even just like operationally, I was telling them when you use a property management person, you're managing the property management person, one person.
Exactly.
They're managing all the chaos that ensues. But so say for example, someone goes down that I want to rent my house and I want to buy another one, right? So they're not
Sure.
getting the funds from selling their first primary to second one. They want to rent the first one. For a DTI and all that pre-qualification, pre-approval standard, kind of walk through because a lot of people don't understand this part. So let's say, okay, for example purposes, for whatever reason, I have a home and the mortgage is 3 grand and I'm renting it out for 3 grand. I have a lease in place for 3 grand.
Sure.
Boom, shotgun.
So, you know, with qualifications for loans, the best you can ever do when it's called departing residence rent, the best you'll be able to do is offset the existing housing expense on that property. Okay. Now, depending on the loan program, it might be a couple different ways on how you can use that, whether that be through the lender obtaining a market rental analysis for projected rents, and they'll go off of 75% of those projected rents, or on some programs where they require you to actually obtain a lease and receive your first and last month's rent deposited prior to closing, is how they would look at calculating that number. So if you're in a good position, you're going to be completely offsetting any housing expense, your mortgage payment, taxes, insurance, and HOA. But you might end up in a case where maybe those exceed what you can get in rent at 75% of the projected market rents. In that case, you'll have a bit of a loss in the qualification for the new home. Perfect scenario is you can carry both mortgages, right? That would be the easiest route to it. But for those who are, just getting into this, it just depends on their certain particular situation for themselves.
Now, because it's a primary and they're trying to get another primary, that's what happens. If it's an investment property, do those standards still stay the same?
Yeah, I mean, they can still keep the primary financing on that property that they're departing. The only time you really run into things of that nature is if, you're buying another FHA home. Let's say you have FHA financing on this property, you're going to get another FHA loan. FHA does have some guidelines and required distance from the existing home. VA obviously is a bit different with the entitlement that you have used possibly on that. So you can have more than one VA loan, obviously. But if you have some entitlement tied up on that property, the new property that you're buying, you might not have enough to do zero money down. You might be having to put a little bit of a down payment down. And or, depending on where you sit with everything, maybe look to refinancing it into an investment property program out of a VA loan to free up all of your entitlement.
So now you said earlier that, so if I, rent this house out 75% of whatever the rental appraisal comes back or whatever, and I can only do is break even, basically not affect my DTI at all, which is awesome if people don't
Yeah.
understand math. But if it was an investment property, I can charge it as income. So say I'm renting it, my mortgage is $2,000 and I'm renting it for 6. Based off of that 75% comparison, is it still the same calculation?
Well, I mean, if you're currently renting it, are you saying? Like
Yeah,
if
so it's a true investment property.
if it's currently showing on your tax returns, then
Boom.
yeah, you can use whatever income on the bottom line of your tax return. So it essentially just in a very broad breakdown, gross rents less any
Yep.
expenses, mortgage payment, et cetera, gives you a monthly amount that you either net or gain on that property that we can use as income or loss against the qualification for the loan.
Perfect. That's what I was trying to get out. So a lot of times on the real estate side, people are like, "Hey, I want to sell. I want to keep my home. I want to rent it." So in your head, what Jason just told you is that you will get 75% of the lease that you get, hypothetical lease, or the appraisal rents. Now, if the home's been leased and it's on your tax returns, that's when you can count it as profit. Because sometimes people they combine the two, thinking like, "Oh, well, I made $1,000 a month profit on here," and it's like, is it on your taxes?
Yeah. Well, and the reason why they do the 75% is because, lenders understand you're going to have expenses in operating an investment property. You are not
Exactly.
going to net what you receive. Same as
Exactly.
when you look at self-employed individuals. There's nobody who's self-employed or 1099 contract employee that is saying, listen, I don't want to take the tax shelter of being able to deduct any of my expenses, and you go off of your gross 1099 or what have you.
Before we go on to the next section, I'd love to offer you my free 5-day home buying course. It's packed with simple, actionable steps to help you land your dream home without the stress. In it, you'll learn how to understand the market like a pro, secure financing without all the headaches, and craft a winning offer without overpaying, not to mention more. So click the link below and sign up for my free 5-day home buying course. So now,
So
And save
it's
that. That's for next podcast. Talk about
just
1099 and self-employed people how they get
sure.
pre-approved. But so say clients of this hypothetical person, let's call her Sally Joe or Mary Beth or whatever you want to call her, and she chooses to rent her current home, San Diego, wherever. Say she doesn't want to rent it. Now she wants to buy another home, right? She wants to use the proceeds from said condo, starter home, whatever, and to buy another home.
Yep.
Let's talk about contingent offers. And you
Sure.
obviously work more places than I do than just San Diego, so you can give more of a national view. But your breakdown of a contingent offer? They hear me speak of them.
I mean, they're not going to be as attractive as, I don't care what market you're in, they will not be as attractive as the person that doesn't need to sell their home first to
Yeah.
buy.
So
Most sellers, I mean, even if the sellers need time before they sell to
yeah,
get their replacement home,
yeah,
I mean, it's an added risk to them when your home might sell if you net what you believe you'll net to impact the qualification of the loan you expect to get for the purchase.
yeah.
So it does dampen, your offer compared to if there's competing offers on that same home.
So it was caveat for people that don't know. Contingent offers basically saying I'm willing to buy your home, even though it's contingent on me selling this home. And in San Diego, like Jason was talking about, it's not as attractive because at any given point we can get through appraisal, we can get through inspection, we can get through the loan contingency, and then still not buy the home and be fully out of the contract. Now, from your experience dealing in other markets, I don't know what it's like in New Mexico or anything like that.
Right.
Have you seen any of your other realtors, your second class, third class realtors on the non San Diego realtors, come into any of that and it actually goes through?
Yeah, sure. I actually had, interestingly enough, a conversation with one of my top realtors in Florida today. We've got a client that's been sitting in waiting for his home to sell before he buys, and all the while kind of watching the market pass him by. And still at this point in time does not know when he'll be ready to buy because he's waiting for his home to sell. And again, even if you're in a market where your home can sell a bit quicker, it's something to at least consider. I mean, I don't think any one option for somebody is definitive until you've viewed all options, right? I mean, it's important to look at
Situational.
Like, why or why not this? What does it look like? Why or why not this? Because when you're making a decision, you want to be informed, and you can't be informed if you don't know what are the other options out there and why would I choose not to go with that one over this one, right?
Exactly.
So, what we're getting at here is what are the solutions for these problems, which are bridge loans, which is going to be our segue here. So
Yeah, that's perfect. Hey, man, you took it right away. I was like, hey.
Yeah, so I mean, bridge loans are an interesting solution. You've seen a lot more of it recently in these markets with elevated rates because in some markets, homes are sitting a little bit longer because buyers are hesitant due to inflated rates.
So tell them to break it down because most people don't know what a bridge loan is. So
Sure.
What is a bridge loan?
So a bridge loan is just a temporary. It's a temporary loan allowing you to access the equity in your home that you'll get, in advance of your sale. Okay. Traditionally, I think the way most people view how do I buy a new home out selling this one right now is through an equity line of credit. Equity lines of credit are great loans, great ways to access equity in your home. And I've done plenty of those loans to help people buy new properties. Especially, but if you're holding on to it, it's a bit of a better deal, right? If you're looking to sell, and there's a number of different bridge loans out there, but we have a couple specifically, one in-house that we use and a couple others that we can execute as well that allow you to actually forego the requirement to count the departing resident's mortgage payment that you currently have and are responsible for, as well as the bridge loan payment against you in the qualification for the new purchase. That would be the big problem for most people if you're not very cash strong or have a very low debt to income ratio, is to qualify for a new home carrying multiple mortgage payments when there's not projected rents coming from the second property, right? The one you're departing.
Yeah. So let me break this down in more third grade. But essentially what they're doing is making so you don't have to do a contingent offer. The bank's essentially saying, hey, we're taking over. And then because it's in-house, I, the bank, know that, hey, you, Ian, I gave you the money for this, so I know that you're selling this house, so you're not risky. So now I can pre-approve you for an amount without taking this money this debt into consideration. And it basically allows you from the real estate side is you're not submitting contingent offers anymore. You're doing, good to go. So now on the
thing that people, I think, get just to touch on it, because I have a lot of people call me, I want a bridge loan, and I want to take all the money from the bridge loan and go buy the new property cash. It does not allow for that. That is like the one thing it doesn't allow. The reason being is because banks don't make money on bridge loans. There's interest collected, but there's not revenue really from them per se.
and it's also risk.
So you do have to obtain a mortgage on the home that you're purchasing in conjunction with the bridge loan that you're using as down payment.
And risk. It's just risk. Like the banks basically.
Yeah, because what if the home sits longer? I mean, everything's risk when you're talking about financing.
So for cross country's bridge loan, the in-house one, so give us some of the requirements, right? They get how much can the equity can they touch? So let's say $1 million. Let's say $1 million. For example, purpose people love numbers. Let's do $1 million home. I only owe $600,000 on it, and I want to buy a home, whatever, $1.5 million home.
Yeah, sure. Yeah, the home that you're buying is doesn't matter as much. So it's $1 million home. You owe $600,000. We'll go up to 85% overall CLTV. So in this scenario, you would get $250,000 in access to your equity early.
Explain CLTV. Don't just put
the combined loan to value ratio. So
you
the combination of your primary mortgage plus the bridge loan, which is technically a second loan, versus the overall value of the home. So you have your LTV, which is your primary mortgage versus the value. If you have two mortgages, you have what's called a CLTV, the combined loan to value. So the two mortgages, or it could be three mortgages if you have a second already combined, to equal your overall equity position in the existing home.
Perfect. So then in this scenario, they'd have access up to 850,000 minus the
current mortgage of 600, leaving them with 250. Now you do have to have a listing agreement with your current favorite realtor in place. But other than that, once we approve that, we're going to qualify you with those funds as your down payment for the new purchase. Now, on the bridge loans, there's no monthly mortgage payment made. Okay. The interest rate you qualified for, there will be, interest collected, but it's not paid monthly. It's just tacked on to the balance. So let's say, hypothetically, you're borrowing, let's say, $450,000 at 9%. Hypothetically, let's throw out a number, $3,500 in interest monthly collected, roughly. Let's say it takes you 2 months to sell your home. That's $7,000. They would take that $450 bridge loan plus $7,000, so $457 is what would be taken from the equity when your home is sold and paid off.
That was another thing I wanted to touch on too, is people, we had an issue with one of our clients, started to look at properties already, and his home wasn't even listed on the market yet here. Like we'll call him John, and looking in Maine and all this stuff. And it's like, I think for clients on the real estate side of the house, they have to realize that it takes planning, especially when you're doing out of state or, even local. To be honest, you have to plan. And there's steps to it. You don't want to bypass. Like, yeah, you can surf on Zillow and look at your next dream home, but don't start getting knee deep in the weeds until you've gone through it. And you're going to take longer time if you bypass. If you go straight to the lender, like, I want a bridge loan, Jason's going to tell you, like, you need to talk to Ian to get it listed first. So if you just start the natural path of things, it actually works out smoother. In the real estate, in military, we say slow is smooth, smooth is fast, instead of bypassing everything.
Once you get all the heavy lifting done, it's a light jog from there, or you can sprint quickly. But again, it's effortless once you've taken care of all the important things. You also have to get a broker price opinion on the home or an appraisal. That takes time. Like anything, if it's something like as important as buying real estate and the money spent and invested in real estate, you should be prepared.
Oh, I'm shocked. People time look at their cars.
More people shop around online without actually going through the process than actually doing what needs to be done. I saw them advertising this. I saw them advertising. Did they qualify you? But you know how far that goes. As a recent experience we had with a lender that had been working with the client for a year. They all of a sudden had a problem during contract.
Yeah, and Captain Jason had to come in and save the day. But that also goes into another thing, and I wanted to save that for our other realtor whatever video. But as realtors, you have to also understand where to find the information, because on both sides, right? Not all lenders are created equal, not all realtors are created equal, and doing just a little bit of due diligence and a little bit of effort to look up, to ask questions, and that's what was ours. I was like, that using that doesn't sound right, and I told the clients that, and sure enough, blew up the deal because of faulty information and not reading the actual rules and regulations, bibs, whatever you guys call them, and the nerdy guidelines, nerds, didn't fully read them. So in due course, at the end of the day, as a realtor, we're the coach of the team. Lenders are important, and you guys are the quarterback. But at the end of the day, the coach has to win the game and do what's best for the owners of the team. And at that point, you have to do what's best for your clients, and that means pushing them off to you, someone who took 9 days to get it clear to close.
Yeah, I think there's a difference in our industry. I'm talking to another realtor again today about it, because we have these kinds of conversations, and discount services get you discount experiences. Are you viewed as a commodity, or do you hold value? What is your value? Because you can look at, hey, I'm sure the Kansas City Chiefs could go find a value at defensive lineman and spend less money. Or you can pay, Chris Jones, a lot of money to get the results you need, right? To win, essentially, because that's what we're talking about, is winning. Same defensive linemen probably all know the same playbook, know the same techniques, get coached by the same coaches, Do they perform the same?
Nope.
And they just simply don't. Yeah. You pay for what you get. The people that are focused only on rate, or focused only on what is my realtor's commission, I would strongly suggest they see your lender or realtor should be able to articulate their value to you. What's most important in our industry is, one, do they win you the offer? Do they provide you service at a high level? Those types of things matter. But if you're going to end up in a situation where it's just like, my realtor is only charging me 1%, well, what service do you get for 1%? My lender's giving me an eighth of a percent better rate than you. What comes along with that? Right?
Waiting.
So
a lot of waiting.
Yeah.
But that's the thing too. And I think I mean, yeah, realtors and lenders in general, we're part of the problem, but it's also an existential, problem. Because think about it. What's the normal flow of, from I don't know you to now I learned of a realtor and now I got, passed to this, lender, and all this stuff is they start on Zillow. And when you meet your realtor through Zillow, there's no rapport, there's no relationship. 99% of the time. Don't get me wrong. Like Tippy and Michael, that loved them to death, the closest friends, whatever. And that was one of the few people from Zillow. So that was like outlier. But still, 99% of the time, you meet someone on Zillow. They don't care about you. They don't care about your referral to your close friend lender. You're a door opener, not even a commodity. And that's where I'm trying to talk to more realtors. Quick plug, course coming out on how to acquire clients that actually know, like, and trust you. Because if you get a client from someone that's focused on the home and not on the person that's going to deliver them to the home, you will always be let down. If you find the person that will lead you the right way and get you to the end state goal you want to be, and then use them to help find you a home that you can afford, your experience will be so much better.
Absolutely.
And before we go down that rabbit hole too, just to summarize this podcast, because we have another one coming up too, talking about VA loan assumption, is utilizing the bridge loan, especially in competitive markets. Jason can tell you about desolate markets. Utilizing them. HELOC and bridge loan are variable options depending on your situation and what is your end state goal. Regardless of what you're doing, make sure that you sit down and talk to a lender and a realtor to map out your game plan and timeline. And
fully understand your options.
Fully understand your options.
Enough. Fully know your options. Don't be told one thing is what you should get without knowing why not something else.
Options and also consequences for you, because no matter what your decisions are, your options, there's always going to be consequence. And which one is what's risk, as we say in business, is okay with you. And then, shoot the shot. For anybody that wants to ask more loan questions, if you look at the link below, I have all of Jason's links in here. You can set up a free consultation with him. He'll break it all down. I also offer a free home buying course that I already probably plugged earlier in the video after edit. 5-day home buying sequence that'll basically give you everything you need to know to buy a house in San Diego. If you learn how to play in the pros when you go play in the college, it'll be easy. So if you learn how to do it on the San Diego level and you apply that to Texas or Florida or whatever, you'll be fine. And that's all I got. Jay, I appreciate you coming again, even though we had some technical difficulties, brother. And any final parting words for the millions of people?
Yeah. No, I mean, obviously, like I said, do your research. It's an important, decision in buying a home. Know you're working with real professionals. Get the information you need. You should walk away from any conversation with the real estate professional feeling educated, not sold.
Educated, not sold. If that's not a closing point, I don't know what is. Appreciate you, brother.
Anytime, man. Happy to be on.